Hey there, thanks for watching this video. In this video, we're going to be going into greater depth and detail on permanent life insurance so you can be familiar with the ins and outs of how it works and so that it can make sense. That way, if you're sitting down and meeting with a life insurance advisor or salesperson, that you can understand what it is they're talking about, because typically they start showing you these illustrations that are these like 10 to 30 page documents, and they start talking in like a completely different language. So we're going to demystify permanent life insurance and talk about the basics of how it works, okay? So, and I hope that you can read my handwriting that's worse than most doctors, but since we've been talking about life insurance, I figured that you could kind of at least read the permanent part of that life insurance. So let's talk about how we pay for a permanent life insurance policy. Most permanent life insurance policies, you can pay into them kind of like this, to where you may have a minimum amount that you have to pay to keep the life insurance in force. That this is the bare bones of what you have to pay to keep that life insurance in force. Now, typically, what this minimum amount does is it goes towards, obviously, paying for the costs of life insurance, which I'll abbreviate as LI. So you're paying, the minimum obviously pays for the costs of life insurance, and then the second thing that it typically does is that it builds some cash value, which I'll abbreviate as CV. So it builds some cash value. Now, depending on the policy, if you're just funding it to a minimum amount, typically that cash value isn't going to be much to write home about. And so I always chuckle when I have investment advisors or financial pundits or gurus who talk about how, you pay for this and it hardly builds any cash value. Well, yeah, if you don't know how to structure it, then obviously it's not going to be much of a performance. If you just talk about how I only put $20 a month into my savings account, and then with the minimum amount of interest that you get off of that, it's like getting mad that you haven't been putting $50 into your savings account. It just doesn't make sense. If you don't fund it appropriately, then obviously this isn't going to be the coolest, sexiest, financial product that you can use. Now, at the opposite end of the spectrum is we typically have some sort of a maximum amount. We typically have some sort of a maximum amount that we can put into a life insurance policy without losing some of the tax benefits of a life insurance policy. You can, go blow right past this maximum amount, but you just may have some adverse or negative tax consequences, and you may not be able to participate in some of the tax benefits of life insurance. And so there's some situations where that may make more sense. Like, for example, if somebody's got, $50,000 sitting in a CD, at their bank, if that doesn't, like, if their goal is accumulation, that's probably not the ideal place to put that money. So there's sometimes where we'll take that $50,000, put it into a permanent life insurance contract, and it may be more than the maximum amount, but then they're just going to be taxed like a normal investment, and it's going to lose its tax-free status and stuff like that. So it's not the end of the world, but we just want to understand how that works. So these maximum amounts are actually typically set by the IRS. And the minimum amount is obviously going to be set by the life insurance company. Now, most life insurance companies, they use, as far as the costs of life insurance, they're pretty universal from company to company, because they use the same mortality tables, meaning that they're looking at all of this data of how long have people lived, and what's the typical life expectancy of a male, what's the typical life expectancy of a female, what's the life expectancy of someone who uses tobacco, who doesn't use tobacco, and they're able to come up with all this statistical data, and that drives life insurance rates. There are some outlier companies to where they just charge exorbitantly more than what the standard rates may be, or what most life insurance companies are going to charge. And then by that same token, there's companies that charge significantly less than what you'd see on the average. Those are the companies that I would be wary about, because it's kind of like I'm building a wall here, okay? And if I come and get a bid for somebody to build a wall in my yard, I'm thinking about this because we're in the process of building a house right now, and we just built the back wall and now we need to build a side wall. If I got multiple bids, and let's say that 3 of the bids came in all around the same amount, and then there's one guy who came in and he was half as much, I would probably not even consider that guy who's half as much, or maybe he'd pique my interest and I'd be like, what do you do differently? And he may be like, well, rather than using cinder blocks, I'm just going to build a mud wall, right? Like, that's obviously a difference in quality. And so if you come across something that's just like way cheaper than everything else, make sure you're reading the fine print, because yeah, that price may be lower, but at what cost? And we'll have that price versus cost comparison in a future video. But understand there may be something that's totally different, where they may have all kinds of exclusions to where if you're wearing a red shirt on a Thursday and you die in a car accident, then they're not going to cover you. You know, obviously that's an exaggeration, but just to give you an example, they may have some sort of crazy exclusion on there. So just understand that difference. Now, this top maximum amount is typically set by the IRS, and then the minimum amount is obviously set by the company. And these figures should be pretty relatively similar from company to company to company. Now, not every company's products are going to be similar, but some of the baseline prices should be similar. So this is the basic amount of how it works. So let's just use the example. Let's say in this permanent life insurance contract, let's say it's a small one, and that the minimum amount is $50 a month. Okay? So that $50 a month is going to pay for the costs of permanent life insurance to take you out to age 120, or you could structure it to be 110, or however you want to do it. It's going to pay for the cost of permanent life insurance, and it's going to build some cash value. Okay? Now this maximum amount here, let's say that is, we'll say 150. That should be fairly similar math. Typically this is a third of what that, we won't get into that. But let's say that this is 150 per month. So the way that this works is, if we're going to stay compliant with IRS guidelines so that we don't lose any of the favorable tax benefits of life insurance, that means that the first $50 that we're putting into this account or into this policy, that's going to go towards the cost of life insurance and build some cash value. But then this $100 difference between here and here, this $100, this is all building wealth tax-free. This is so cool. So that is building wealth in a tax-free manner. And so that as that money grows, then you're going to be able to reap the benefit tax-free if you understand how to take the money out of the policy as well. Because it's not just about how we structure the policy, it's also about how we take that money out and how we set it up. Kind of like you can be driving on the most well-constructed road, but if you don't know how to operate that vehicle, you may find yourself in trouble. And so more often than not, when I hear people who are, anti-permanent life insurance, it's typically for either one or two things. So either one, the person who set up the contract didn't know what they're doing. They didn't know how to build the road. They didn't know how to build the financial pathway here to help this make sense for the individual. Or secondly, they didn't know how to drive the vehicle. And so it doesn't make any sense to be like, this entire subset of financial product of permanent life insurance is terrible. You should never buy it. When their objections typically fall back into that they didn't know how to construct this path, or they didn't know how to construct this road, or they didn't know how to operate a vehicle or utilize this properly. Because when this is properly structured, I'll go so far as to say that this is the most ingenious financial product ever conceived by man. More ingenious than your 401k, more ingenious than savings accounts, more ingenious than most investment accounts. That when structured properly, this gives you so much flexibility, but so many people have no idea how this stuff works. So you're going to be one of the few who actually does. You're going to be one of the few who understands the basics of how to structure one of these properly, how to build the road correctly, and then how to operate your vehicle on that road correctly. So hopefully this makes sense. So this is our 101 video of permanent life insurance. We're going to be going into greater detail on some follow-up videos to go a little bit deeper into this. So thanks for watching. We'll catch you on the next video.